Hello, everyone. I'm so happy to be here. Today, as usual, I'm just going to give the market update. And before that, really quickly going to go through some of the offerings that we have. The big one that we are having is the Best of Wyckoff conference. This is the conference that we've been hosting for the third straight year. It's online and on demand, so you don't have to be there. It's on September 2nd. It's a Labor Day. And we have such a collection of Wyckoff talent throughout the conference. I'm not going to go into all of the presentations. Just go to our website, wyckoffanalytics.com, check out the schedules, check out the presentations. Also, we are offering on September 9th a free webinar or the first class of the Wyckoff trading course. On August 28th, a free webinar on the Wyckoff market discussion. This is the session that I conduct with Bruce Frazier. And also wanted to mention that we've launched quite a few blogs over the summer on different Wyckoff topics, including cryptocurrencies, scanning, trades, campaigns. So go check it out. All right, with that, let's move to our market update. Well, I usually start with this slide. Kind of want to give right away the perspective on the market itself. So, and perspective on different timeframes. Long-term trend is still up. If you have a question about the scale here, go create an arithmetic scale and you still will see that we are still uptrending. In the intermediate trend, we're still in the trading range by far. We are touching all of the resistance points right here, and this latest reaction, this is just another attempt to go up. By the way, look at this. We tried to go up once, we tried to go up twice, and now we had enough momentum to overcome that. The price did not came back into the trading range right away, which is a bullish sign. And look how much time the price is spending above the resistance that was created by the previous high. So that's also a bullish sign. Short term, I think that we are in some kind of trading range here, maybe upsloping trading range. The short term, there is really nothing to worry about. We don't see a lot of distributional qualities in the way how supply comes in. Even yesterday on the news, and I don't have today's date, today's update on the chart. So this is yesterday. But supply that's coming yesterday is not in line with the effort that was shown to us in October. And also, the result is not as great as well. So again, a bullish indication. Also wanted to point your attention that, as we've talked a lot about this rally right here, we saw the momentum kick off. This is the rate of change 21. And then look at this, just recently, even on this smaller rally, we still have some buying behind this rally. So again, there are quite a few bullish signs. And I keep telling my students that I don't see anything distributional now. It has to be a break in the price structure, which is significant break, and it also has to come with a lot of volume and a lot of supply, where we see institutions that's selling in bulk. All right, let's go to the next one. This is something that maybe you've seen from me as well. This analog that I'm showing here is from 2016. We had a rally after the decline of almost 15%. The rally that has been very momentum driven off the lows in January, February of 2016. Reaction, which reminds me a lot of what we've just had recently in May, and then an attempt to rally. And again, we are rallying here. So this is a very good established analog for us. So let's see what happens afterwards. All right, so in 2016, as we rallied, we are going into some kind of localized volatility event. That was Brexit. And obviously that was a huge event. But we could analog this and we could expect that some kind of possible short-term volatility should come at this point. And it seemed to me like yesterday and I was preparing for yesterday was the trade. I'm going to show it to you in a second. That Fed could be the reason why volatility, or rather Fed's decision could be the reason why volatility, local volatility can come, and you could take advantage of that. Well, before we go on into the actual trade, I want to point your attention that in 2016, when we went into this pattern, we actually stayed there for some time. We stayed there for almost 6 months, and we just had, deviation around the mean. Obviously, two events, the Brexit and the election, were on the agenda, and the market participants were just waiting for the results of it. Well, we have quite a few catalysts that we are waiting on as well. Tom has mentioned at the top of the session Fed decision. Are they going to cut again? I kind of agree. You either cut, 50-point basis and, just send this message, a stronger message to the market that we're so accommodative and we're looking into the inflation, rise of wages, and so on and so forth. We also have a lot of uncertainty on tariffs, China, so that could lead into some kind of trading action where we might have localized increased volatility both on the upside and to the downside. So I think it's going to be a challenging market going into the end of the year, especially into the seasonal low of October, November, and therefore, adjust your strategy. So what was my strategy yesterday? And obviously, as I was thinking about this strategy, how to execute on that, how to make this trade, I was thinking about this, even a week prior, anticipating that on Tuesday, Bank of Japan is going to have the rate decision. Then on Wednesday, US is going to have the Fed decision, and then ECB on Thursday, I believe. So I thought that by itself, it's going to create some kind of volatility, and we are going to have an opportunity to trade volatility itself and the direction too. So the question was for me, with this trade is, what am I trading? Am I trading direction of the volatility? And I decided to trade volatility. So I typed my entry on the S&P 500, and I'll explain why exactly this entry happens here. But I'm buying actually the calls on VIX, and that trade worked out. I was not really thinking that I'm going to hold on to this trade for a long time. I thought that the maximum duration of this trade might be a couple of days, not weeks, not months. I was just expecting a local volatility, and that's how it came about. After the decision, we have a decline, very sharp decline, and volatility just increases. Volatility increases, and the value of the VIX goes up. And you don't want to overstay here, especially when you see a demand tail like this, where you're thinking that this demand tail represents institutional buying. The reasons for that trade were expectation of the short-term increase of volatility, catalyst with Fed decision, technicals, diminishing upward thrust. So we could kind of see after the climactic action, every time the price goes up, it stops, it stops, it stops, it stops, it stops. So that thrust to the upside was diminishing. And then obviously increase of volatility inside of this channel, inside of this trading range shows some signs of weakness. So after the break, it was kind of an easy entry point, and it was close to the catalyst. Well, let's talk about other market analogs, and I always like to bring different analogs. This one is going to be the analog on the Fed funds rate. So, Tom, you might like this. This is the data, economic data, that spreads out, throughout each month in 1994-96. There is a great analog which I think that we should be exploring. From 1995-1996, we had a rise in the Fed funds rate by that time, and then suddenly the Fed decided, yeah, we're going to cut. What were the reasons for that cut? So I went and I read some of the material about that area. Would that surprise you that the main reason was the economic slowdown, or the worries, the doubts that in the economy is not growing well. And I mean, look at the GDP growth. This is really dismal GDP numbers. We obviously were in a slightly different environment overall. We had high Fed funds rates, we had high unemployment, we had high inflation, but the pattern, the technical pattern was the same. It's the rise and then the cuts. So what that produced, and by the way, they cut not only here, but they cut here as well in 98, and that was associated with the Russian default. What that did is that produced the short-term liquidity that allowed the market to run away in 1999 and into the 2000 high. And then we could see that the Fed, as always, late to the party, as always, trying to catch up. So I'm thinking about this analog just because of how the Fed is acting in the similar conditions, or at least in a similar worry state of the possible economical slowdown. Let's look at this from slightly different perspective. In 1995, the last rate hike was in February, 50 basis points. And then in July, they started lowering. Then they lowered again. Then they lowered again. So we kind of, should send a letter to the Fed and say, you've done this already. Maybe something else. Be more aggressive. Be more decisive. But at the same time, we should look at this as an opportunity. Opportunity for what? How would we trade these markets? Well, let's look at the markets in 1995-96. What were they doing with this type of the conditions? Well, we had a pre-election year rally in 1995. That was one of the best rallies historically in general. And it kind of has that momentum characteristics that we could say are similar to the rally that we had since the lows in December. And then look what happens next. Going into the election, again, something of an uncertainty, some event that market anticipates. We went into the trading range, and this is going to be my whole premise for today's presentation, that we possibly could go into a trading range going into October, November, and maybe even into the end of the year. There's just too many things that kind of point into that. Well, let me show you what else I'm looking at. And by the way, here on this chart, look at 1998. That's when the Russia default crisis unfolded. They were lowering, and rightfully so, because they needed, to pump up liquidity at that point. But look at the structure. Does this remind you of the shakeout that we just recently had? And then look at this structure right here. It doesn't look like a structure by itself, but if you look at other indices, and specifically at the one that was always a growth in the growth department, composite. Look at the structure in 97, 98 here. This seems like one structure. It doesn't look like two separate structures. Those are just, local three structures that define a much larger structure. So what do we see here? Well, the final shakeout, and that reminds us so much of the structure that we just had recently. Going into phase C, this is the final C in Wyckoff methodology, where we are testing the previous lows, and usually we are going to have a lot of volatility going into phase C. This is where the value and liquidity are going to be found by institutions, and on the rate cuts at that point of time, imagine how much liquidity was given to the market, and that's what happens after the liquidity is there. We have a very big momentum rally. Just going through the analogs here, big run up, change of character, absorption for the next rally, some pattern of the distributional pattern at the top above the resistance. Please note how much time the price spends there above, suggesting strength, and then localized distribution, and then a shakeout. So everything kind of matches very nicely. And obviously the rally, I mentioned the rally. Look at the duration of both. The trading range, kind of the same duration for the rally. And then what happens next in 1999? Well, we are going on the composite into a trading range. This is a trading range. It's just upsloping structure. It's not horizontal. And that trading range has lasted for 9 months. So that's another idea that I have about the way of how the market might be unfolding into the end of the year. We might have new highs, and they will be advertised by the news media. But at the same time, we will not make a lot of progress to the upside. The more defined bias, we're still gonna, go up and down, consolidate. And therefore, I'm suspecting that we might have some kind of sloping structure, or we might have a scenario that we had in 2016. If that's the case, well, what's going to happen next? And this is something unusual for me. I don't like to make, such long-term predictions, but this is just too much fun, so I can't resist it. This is the 1996 analog, so think about this. We just had a rally, then we go into the trading range, and then into the election, we go again into the rally. And in 1999, a rally, a trading range, and then a speculative run. And this is a very interesting idea that we've developed together with Bruce in WMD class just recently. It seems that the market, after some of the uncertainties, it's going to be gone. And after more liquidity is going to be added to the market by the Fed. And they probably will do so unless they see inflation numbers improving, or commodities starting to rally more aggressively. But after that, after those uncertainties are going to be gone, and hopefully after the tariff resolution as well, I think that 2020 might be a very interesting year. It might be a very speculative year. It might be the year where the retail trader and investor are going to come into the market with a lot of force and a lot of money. And this is where big institutions are going to use this opportunity not only to mark up the price in the market, but also to dump some of the stocks into weak hands. And I wonder if that's what's going to happen. So this is just a projection. So how would we trade this? I'm going to give you several ideas. Some are ideas that I'm trading right now, and some of the ideas that are maybe controversial, and I'm still looking for the confirmation of those. Russell 2000, I think, is a really good potential market outperformer. Why? And we've just talked about this in the last WMD class. Look at the texture of this structure. It's very horizontal. There is not a lot of retracement off the top of the rally that we have had. We are retracing what going into the sprint, maybe 1/3 of the move. So this is basically nothing. Then look at the texture of the structure from the perspective of the downswings and upswings and the spread. What do we see? Do we see any significant selling? Well, maybe this bar right here, maybe this bar right here, maybe this bar right here. I don't see anything else. And even those bars are going to have some demand signatures behind them, because a lot of them are just stopping actions. So you assume that there is a demand right there. So there is not a lot of selling here, but there is a lot of inactivity by institutions not to participate in the small cap space until what? Until the time when it starts to locally outperform. And obviously, the Fed red cards are going to help out small caps because of the cost of business and the cost of borrowing. So I do have a position. It's a very long-term position. I'm looking into 2020, on options. for this position. And looking at the swing counts, and I'm calling this not a campaign, but the swing count, 48 columns all the way through, and the minimum maximum count is 193 to 203. So this would mean that we're going to make a new high in Russell 2000, and I think that that will probably come, into the first maybe quarter or the first 2 quarters of 2020. Why do I bring this up? Russell 2000. I think if the market structure is going to be such that we're going to have some trading range that is, let's say, upsloping, Russell 2000 has an opportunity to outperform in this environment, especially if the Fed is going to continue lowering the rates. So that's one of the ideas. What's another one? I really like semiconducting stocks. Look at their regional base that we've been in for years and years. This is the business cycle where semiconducting stocks have not participated in the market run up to the new highs. And usually there is this switch between the cycles. So we are currently in this cycle where semis are actually leaders. And what's interesting here is that we have cleared, and this is SMH, we have cleared a long-term resistance. And we are testing this resistance. We've tested it. And we are in the trading range right now. Well, look how volatility increases in this range. Usually we would say that increase of volatility is bearish. In this case, we're seeing that as volatility locally increases to the downside, we have really quick rebounds to the upside. So it's still leadership characteristics, and in itself, a lot of local momentum and short-term volatility suggest more participation by institutions. So I'm thinking that this is the theme that they've been favoring for quite some time, and they're still favoring it. And if we look at the PNF of this formation, of this reaccumulation, we have quite a few. We have quite a few of the room to go, over 200. 212 to 132 from, let's say, 100. That's almost a double. So think about that scenario of the rally in 1999 that produced in NASDAQ Composite a rally of 95%. So this is very close, almost doubling. All right, another idea, and this is something, I'm going to end my presentation with this, and you guys have a poll about oil. The first thing that is so interesting to me is the analog of the price structure from earlier years. So follow my logic here. We're looking at the declines in both cases, and then we're looking at the trading range that has lasted 5+ years. We, in 2008, 2009, we had an extreme oversold condition. Usually out of the extreme oversold condition, the first move is always going to be a rebound. But then you're going to have a trading range. So that duration of the oversold condition and the trading range was very close to what we had before. Then we had a decline of about 2 3/4 years, 2.5 years in our current structure, a move up, trading range for almost 2 years. Here we are somewhat close to that. Another rally that lasts the same amount of time, a decline again, and then here in 2003, we are in the local trading range, going up and down, up and down, up and down. Remember the climate that we had, the environment at that point of time. We just made the final low in the market, and the market was starting to go up. So it's very interesting how this analog unfolds. What happens afterwards in 2004? Well, we had a rally of over 100% in 2003, 2004, since the lows here at about $25. Could we do it again? I believe so. Let's look at the PNF counts. and I'm only looking at this latest area. So the first count that I have goes to 77.84. The second count, a larger count, goes to 94.102. So that kind of confirms that, yes, there is a possibility, of a good run up in oil. My problem with oil, and I do have a position in oil, which is a probe position. I usually do those probes to establish a position and to see if I'm right or wrong. I might be a proven wrong on this, and this is a very long-term campaign type of the position. But intellectual challenge about this chart, I think, is all in the character. It's not in the direction. And what I mean by the character is the character of the structure that might develop. There is so much uncertainty about oil right now. And as I read the news on oil, it's not even about what Iran is doing. It's more about the demand itself. Oil is very supply demand driven market. And we're seeing that because of the economic slowdown, the demand for oil is not at its high. At the same time, there is a lot of supply coming out of the US. So that influences, how oil is being traded, how big institutions are accumulating this position, and so on and so forth. So I think that going into the end of the year, we're going to be threading waters, maybe with this slightly upsloping bias. And then after that, in 2020, and especially into the mid 2020, we might have some kind of acceleration to the upside, and that's conditional, obviously, on a lot of things. Tariffs resolution, and then hopefully China is going to pick up. The economic growth is going to pick up there, and then just overall demand for oil hopefully will pick up. So I'm not making this call, but it's just kind of like looking at this as an intellectual puzzle at this point of time and kind of probing these positions a little bit. But if you would like to trade oil right now, what would be the best trade or the best idea? Well, obviously, Tom and Aaron have mentioned renewables, and I've been campaigning that particular group for quite some time. I actually do own SunPower. Since $6, $7 I've been accumulating. So today was a very nice day, to have it on the earnings. But renewables are a little bit far ahead. They are in such extension of the trend and on the buying climactic action.
Hey, Ramon.
Yeah.
I'm sorry to cut you off, but we are getting close on time.
Absolutely, yeah. This is the last slide, by the way.
Okay, just a couple quick things. Number one, your earlier Excel spreadsheet I thought was outstanding, showing comparisons back to the late 90s, mid 90s, late 90s, and then following through with some of your calculations as far as targets go. I think certainly are presenting everyone with a lot of great ideas as we look ahead. I tend to share your bullish views, but as far as the poll goes, because we do have a poll.
Oh yes, let's look at the poll.
And so, are you in that poll? Are you suggesting that you think we'll be above the $70?
I think that we're going to be in between 70 and 45. By the end of the year. I don't think that we're going to go above 70. I mean, there might be a possibility. I think that if Iran is too active, militarily, that could produce that anxiety in the markets, and push the oil above 70. But with all of the uncertainty about the demand, I think we're going to be in between 70 and 45.
Okay, well, we're going to go ahead and bring the poll up and take a look at it, see what everybody else thinks. And it looks like the majority agree with you, but we're going to stay in this trading range. I actually think the same thing. I think that we're going to see some economic strength that could be favorable for oil prices, but I think the dollar is going to continue to be strong, and I think that'll be a headwind.
Mm-hmm.
So I'm going to agree. I'm going to go with that 50 to 65. Aaron, you have any thoughts?
Yeah, I was thinking the same. I was between the 50 and 65 myself. I'm looking at the $60 area as a finish to 2019.
Yeah, if I had to hedge, I'd go above 70. I just think that things will pick up economically around the world just because central bankers are so dovish. But I think the key is the end of 2019. We're only talking 6 months out. I can't see it going above 65 in 6 months.
I would agree with that. If I would bet directionally up or down, I probably would bet up rather than down.
Awesome. All right. Well, we do have to run. It is always a pleasure to have you on here, Roman.
Sounds great. Thank you so much for having me here. It's always a lot of fun.